Oh, good morning, traders. This is Blake, and you are listening to the F.A.C.E show. Brand says, "All hail whoever is running the show today." Brand, it's me. It's me. Dale's out all week. Actually, I think he might actually be out till Tuesday, if I'm not mistaken. For those of you that did not know or have not been, if you've been living under a rock, but you've still been on the show, Dale's in Chicago, back in his hometown, visiting some of his childhood friends or a childhood friend. And so he will be out until Tuesday, I think. So anyway, um, Brand says, I got a real mountain woman in the mountains of North Carolina. Wow. Wow. You got it. Well, wow, that's interesting. Okay. Well,
I thought that most of Dale's childhood friends died in World War II.
Yeah, you know what? Since Dale's not here, yeah, let's pick on him. Yeah, World War II. No, the Civil War.
Okay.
The Civil
Okay. Yeah,
War.
yeah. I'm getting those words confused all the time.
You are, you are. Good morning, Steve. Good to see you, my friend.
Good morning, mate.
Hey guys.
Hey,
Hey,
Grega.
Grega.
Looks like we have another guest coming in here. So you guys,
Yes.
I'm excited to have Grega here because he's probably going to give us an Elliott wave count on the sterling demolition that happened overnight, which I find very, very awesome because I was short sterling up until this morning. So anyway, I'll come back to you in a few seconds, but I just want to say good morning, everybody. Good morning, Ryan. Ingmar, James, Mr. James Groom, that's out in Florida, Hugo, AJ, Patrick, and Ryan said, "Hey, can you throw a light on the dollar Swiss? As Switzerland had very bad CPI. All fundamentals point towards going long on Swissy, yet that is the only pair which is now flat after being up 0.5% on the day. It's literally frustrating to go long Swissy as the pair is so resilient and stubborn to standard 85 cents. You know, let's talk. I can talk a little bit about it just because I'm obviously watching it very carefully. If you guys didn't see the trade-off show last night, it was one of my setups, which I don't have any Swiss exposure as of right now. I think it's being pulled in a couple of different directions, but you're right. Swiss CPI came in weaker than expected. If you guys didn't see the data, let's just go revisit it really fast. So here is the Swiss CPI. You can see negative 0.3% versus 0.1% month over month.
So an extra reason to own the Swiss franc.
Yeah,
Your money is not getting devalued.
There you go. I mean, maybe that's one way to look at it, and also
that's how the markets used to trade until central banks decided to run the show.
There you go.
For the vast majority of financial market history, whenever the CPI was higher, the currency was getting devalued. Whenever the CPI was lower, the currency was getting a bid.
But that's obviously not been the case since you've had this meddling in central banks. And one of the biggest meddlers is the Swiss National Bank. And also just keep this in mind that there's a lot of push-pull in the Swiss franc. We haven't heard rhetoric yet from the Swiss National Bank that suggests that we should be selling Swiss, because remember, they're ultimately the ones pulling the lever. What also is a big issue with Switzerland right now happens to be this, bubbling up of tensions in Israel and Iran. We might be literally on the cusp of another retaliation from Israel to Iran. And if they're obviously, having talks with the United States and other allies, and just making sure it's kosher if they go after Iran. I guess that's what's happening at the moment. But being in that situation, you don't want to be selling Swiss francs. Like I personally want to be buying the dollar Swiss. Personally, I want to be long. And I get what you say, Ryan. Everything suggests that we should be long this dollar Swiss right here. But you have that in the back of your mind if tensions step up anywhere from where we're currently at, which I think we could all agree that that's entirely possible. next thing you know, you're going to have the dollar Swiss trading back at 84 cents. So there's nothing you can do about it. So I get the frustration. I get it. But that is, that's kind of, yes, it is a safe haven, Angela. Absolutely. I've been in discussions where people are like, oh, Switzerland's not a safe haven anymore. That was back here. And I was just like, you're crazy.
Really?
You know?
Why would that be the case?
I don't know. The argument was beyond me. I was like, I don't
Switzerland
understand.
has no enemies, was never in danger, even in World War II, nobody touched it. It has a healthy economy. It has a rich banking system. It has no inflation. I mean, it has everything you need for a country's currency to be a safe haven.
Yeah, and Ryan, you're actually, I don't know if the Swiss National Bank said they were worried about the strength of the franc, because yes, I know the watchmakers in Switzerland have been complaining about the Swiss good. They're just obviously their industry is getting smashed. Then that had more to do with COVID, and everybody just started buying all these luxury goods, including watches and whatnot, and now people are buried in them. They can't sell them. All the Rolexes and all that crap, and so yeah, the Swiss manufacturing industry, especially all the watchmakers, luxury good makers, yeah, they are definitely worried. And yeah, that does power some of Switzerland's economy, but that is not their whole economy. So yeah, they are worried about Swiss strength, but overall,
You forget the biggest reason, Steve, is that the confidentiality of their financial system. It's always been a safe haven for people who wanted to put money over there with no questions asked, and they're not going to spill the beans on who's parked what money there. That's one of the reasons why the Swiss has always been a safe haven.
Absolutely, although that has been watered down substantially.
Yeah.
But yeah, that's why I send all Ryan's money to Panama now.
Yeah, but on the other hand, but on the other hand, Blake, I mean, you have to keep a balance, right? You can't have everything. Meaning, yes, there are still places in the world that you have confidentiality, etc. But do you feel as safe with your money there as you would in Switzerland?
Yeah, no, I get it. No, I 100% get it, and so does the rest of the world. That's why we're at where we're at. It is frustrating if you want to be short Swiss francs. This is not typically the environment you want to be, and I'm just if tensions come down in the Middle East, I think the first place you want to be is short Swiss francs. I want to be short Swiss francs. I want to be in this trade right now, but the only thing that's prohibiting that is, well, shit, there's missiles flying around in the Middle East. Yeah. So until that subsides, we're going to have to put this one on the back burner. And Ryan, look, I think it's the right idea. It's not at the right time. And that's being a trader, is understanding right idea, wrong time. That's exactly where we're at right now. All right, let's continue on this. We're going to continue on we have a lot of stuff we need to cover. We have Joseph Wang coming in today. If you guys don't know, Fed guy is going to be here. I'm actually going to let Steve do that interview today. So Steve, make sure you stick around. Just kidding. You don't have to. I'll be here. But anyway, Joseph Wang's going to be here. Can't wait to have him on in about 20 minutes. But before we get to that, let's talk about what the flying fudgesicle happened with the sterling. Now, I'm going to say that I was short sterling, got limited out on the pattern in play from back on the 30th of September. So 4 days earlier, we were, short. I actually just closed personally. If you guys are in the ForexAnalytix chat room, here's the general chat room. We were talking about the Euro Aussie here. And if you go to the trades room, you can see I closed out all of my sterling, and I closed out half of my Euro sterling longs. Ryan, I think you were playing the Euro sterling long off of the support as well.
Yeah,
that
you
correct?
followed me if I remember correctly.
Yeah, well, we don't have to tell.
Not
Send him
okay.
half the money. Come
You
on.
don't have to like throw me under the bus and say Ryan did it first. Actually, he did. I followed Ryan into this trade. Yes. But tell us, well, first of all, congratulations, very nice trade. But tell us what the flying fudgesicles happened with Sterling last night. Because it was
It's
Yeah.
still
right after we put
happening.
to bed.
It's still at the lows of the
Still
day.
happening, yeah. And yeah, likewise to you, mate, on the trade. Nice on the cable and Euro Sterling as well.
Thank you.
It's Bailey. It's always Bailey. He decided to put out an interview in the Guardian with the quotes that there's a chance that they might get more aggressive on rate cuts. They might become more activist on cutting rates. And the market's gone, okay, that's a big turnaround from what you told us at the last MPC meeting. So naturally, the pound's been hammered. I think it's a big overreaction personally, and I say that even while being short the pound. Over 100 pips in euro sterling we may cut aggressively if buts and maybes, possiblies. I think it's a big overreaction, but I'm not going to complain about. Neither are you. For cable, it's been a case of pushing open an open door. We know the dollar's been stronger, so it's the path of least resistance was a shove lower. But yeah, the real surprise is that euro sterling. That they haven't said they're going to cut 50s, though I expect we're going to be getting some banks changing their minds and coming out with 50 pip calls like everyone else. But yeah, it's given the market a bit of a shock.
Yeah, it's like is they or won't they is the Bank of England going to play a little bit of catch up with the other central banks and start cutting rates? I would have to think if this could happen to sterling, this could also happen to Australia. As people start pricing in the RBA being a little bit more aggressive too. Would you agree?
Yeah, and I've been saying about the RBA for weeks. The market has been sniffing the bullshit from the RBA about hikes. I was hoping that they weren't going to sniff it because we could have seen Aussie going much higher. I'm keeping an eye on Aussie Kiwi actually because everyone and their dog are coming out with 50 pip cut calls for the RBNZ next week.
Super bullish this Aussie Kiwi as a result of what you're saying.
Yeah, so if this creeps up high, we're getting up to some big levels, up towards the 111, those highs we got to last time, 111.50s, I think we got up to, just in that August period. I think if we drive up there before the RBNZ, I'm going to try some shorts because if the market's waiting for a 50 and they get a 50, it's not going to be a shock. But if they looking for a 50, they only get a 25. That's going to be a different kettle of fish altogether. Plus, it can then be a bit of an RBA trade as well. So I'm looking at maybe getting in some shorts in Aussie Kiwi.
Awesome. All right. Well, Ryan, thanks for the update about sterling and really, really great trading there and good job. And like I said, I actually closed out all of my sterling this morning. I have, and you can see I decided to close out all of my euro, my pound dollar shorts for almost 200 pips. And you can see my open positions if you want to, if you're in the ForexAnalytix community. But matter of fact, if you guys don't know, we have our sale, our 8-year anniversary sale. We left the prices up until the end of this week due to being at the first of the month. So take advantage to be inside of our community, be able to talk with me all day. Actually, I just had Sarab ask me a question about the dollar Mexican peso pattern in play and how I'm playing it. So if you want to know how I'm playing certain things and you want to have discussions with me, you have, me for about 14, 15 hours a day, depending on the day, right there. So let's go into Grega and talk about what your views are, Grega, especially with some of these Elliott waves that you post here every day on ForexAnalytix. One of the benefits of being here is reading 30 different instruments on Grega's Elliott wave analysis. What has your attention right now, ahead of the non-farm payroll this week, Grega?
Well, actually, we've been discussing with Ryan and Flow Show this week as well. If someone will watch this recording, I've been turning bullish on the dollar. We've been tracking this ending diagonal for a while. Actually, I've been tracking it for the last 2 weeks or so. And so far, what's probably the most important is that I thought that 102 will be very strong resistance, but we are seeing only one leg from that lows. So I think that we are still missing waves B and wave C, and it means that this dollar rally can last. Also, it obviously will be important how non-farm payrolls reports will be tomorrow, but definitely this appears like an ongoing correction. I think there is more upside. Of course, at the same time, I would expect that stock market will pull back a bit. But what I really like is also gold. I mean, gold is doing very well despite this strong dollar recovery. So even if we see some kind of a short-term retracement on the dollar, I think that there will be a new push to the upside on gold. And I will be looking for a key support around 2,610. You can see that yellow box. I'm in that area. I would be willing to play on the long side.
Okay, so I mean, yeah, I can't argue that gold it still looks really bullish. I know it's down a little bit today, but definitely looks like we're in this. I see your ascending channel that you have here. I'm going to stop you for a second, and well, actually, I want to stop and I want to ask something of you because if you guys are in the, I just want to take you over to some of the comments over here in the ForexAnalytix chat room. So Wuju this morning, he actually just posted a chart which I find really interesting on the dollar yen. The daily chart, we're right up against the Ichimoku cloud. Now we don't have K-Man here, which K-Man's really adamant about utilizing when he trades these yen pairs, utilizing some of the Ichimoku clouds, just because, you know, obviously it's a Japanese methodology of trading. But dollar yen's had this massive squeeze up through 147. And I started shorting it last night. You know, I was looking at it, you know, breaking highs, and I'm like, I've been looking for a move to 148 to 150 to start selling, but last night seemed a little suspicious, especially ahead of ISM today and some of this economic data. So you can see we're pushing up against that cloud. So how are you looking at the dollar yen? Because if gold continues lower,
in the short
that
term,
would be that would actually, you know, support dollar yen strength.
Yeah,
But do you see
in
it
the
the other
short
way
term.
around?
Yeah, actually, I see dollar yen also in a corrective recovery. I think there is room for 149, 150. That
Okay.
would be a very nice resistance. Yeah, right there. So
Well, you're going to have to get in front of my orders, Grega, because I'm going to be up there trying to sell it up there too. So
we will do it both.
yeah, exactly. No,
I
I'm
mean,
gonna undercut you by 1/100th of a pip. I'm telling you.
I mean, that level is also very important when you look back at, or maybe on a daily chart. It goes back to November of 2023. It was also support in May of this year. So this 150, 152 area, I just think it's a massive up there. Of course, I would be looking for not only dollar yen to turn down. At the same time, we see yen crosses making some very similar beautiful rallies. I mean, pound yen is maybe the first one that is already making this bearish reversal.
Yeah. Okay. Well, I'm with you. I think I want to be long yen. I think yen is going to be a good risk proxy moving forward. It's just got the central bank, or excuse me, it's got a little bit of a Ishida shuffle going on right now with the prime minister's comments this last week. Matter of fact, let's go back over to Ryan. Ryan, how are you looking at the dollar yen? And you know, I know you've been kind of focused on it over the course of the last 24 hours or so. What are you going to do with it up here? Do you think we sell it ahead of the jobs or the ISM data today, or are you going to wait for non-farm payroll? How are you playing it? Ryan, you're
Yeah, I'm here, mate.
Okay.
Yeah, I think you got to wait for the data. I did try a little one at that 146.50 level last night before bed, but that got taken out for 20 pips, 25 pips. 147's been my level for a long time since we had that move off of 139s. It's a reasonable area to think that's where this bounce in yields, this move after the Fed is going to run into trouble. We had a little pokey above it. every time we've traded up at 147 in the last few weeks, couple of months, it's had a little extension, 20 pips. So it's done the same again this time, but we're back below. I think if we come through all this data with it intact, then yeah, I can see us setting up a bit of a range. But again, you've got to watch those yields. There still might be a bit of room for those yields to move high, and then you might get your 148s, 149s.
Oh, we could end up being in squeeze city if this data comes in good, especially the ISM services data. As everybody's obviously very well aware, we're in a services economy, and here in the U.S., and if the services data continues to be strong, I mean, yields are going to squeeze, dollars going to squeeze, and there's no doubt about that. But the question is, what if the data starts to actually show some weakening? Then dollar yen might be in a little bit of trouble, right?
Yeah. And I think if you've also got to watch if you're playing this from the long side as well, you've got to watch your risk events, especially going into the weekend. We've still got the threat of Israel and potentially the US retaliating against Iran, and you don't want to be long yen pairs and get a big headline over the weekend and yen opens up 200, 300 pips lower.
Yeah. Okay. Yeah. And that could be scary. And speaking of scary, and I'm gonna talk just a little bit about this, just because I picked up some Mexican peso shorts this week, actually yesterday or the day before. I bought yesterday actually. I bought Euromex. I am getting long, and you can see obviously ascending channel. You know where your risk is, and that's whenever you're trading the Mexican peso pairs. That's it. And if you can see the dollar mex, we have same channel support. And remember, we have a new Mexican government, and if you throw on any risk aversion, and there's so many people putting on. Even last night, I was talking to Chris Weston of Pepperstone, and he bought the Mexican peso Japanese yen. I mean, I get the reason why. I mean, this is yesterday. I mean, look at what happened. And you have I remember Zero Hedge yesterday, if you guys follow Zero Hedge on Twitter, said carry trades back on, screaming at the top of his lungs. Mexican peso Japanese yen took out some resistance, but what happens if we just reverse with these yen pairs? And then next thing you know, you got Mexican peso weakness, and in an environment where Iran could be lobbing more missiles, or Israel too, next thing you know, you're going to be trading well above 20. So I think these Mexican peso pairs, you want to keep a good eye on them. I'm very bullish. I'm bullish on on an incoming U.S. government and an outgoing Mexican government. So
we also had the deputy central bank governor saying that they're likely to keep rates on hold now for a bit.
Who said that?
The deputy Banxico governor.
Oh, did I miss that this morning or overnight? Probably did. Yeah. Oh, well, thank you very much, Ryan. I appreciate that. And that's one of the things that'll keep it a little bid. All right. Or offered for the peso. All right. We have a few minutes, but I want to ask Steve really quick about this insatiable bid in the equity market. Steve, stocks, the S&P back tested twice this week, the 5680 level. So technically we know where stocks turn south, but what's up with the stock market? I mean, do you think this is going to just persist higher? I mean, what's going on here?
For the time being, it's holding, right?
Yeah.
And with literally zero important support levels having been broken, it's extremely hard to make an argument to be short. On the other hand, if actually the dollar index does continue higher, at some point equities will start to care about it, right? And under the current circumstances, we know that both are at a big extent,
interconnected
and influenced by geopolitical developments, which means that it's very hard to predict at the moment because, unless you have inside information of what's going to be happening in the Middle East within the next few days, because I do think that currently the spotlight has turned there, right? Now, if the situation calms down or gets resolved or whatever else, I think the market will go back to, to focusing on economic data, central bank monetary policy, so on and so forth.
Yeah, and the one thing I do have to point out is Israel, and unless I missed something overnight, Israel right now is discussing with the U.S. and other allies what their next step is going to be in Iran. They obviously want to attack. They want to make sure they get or retaliate, excuse me. They want to make sure they get the blessing of the U.S., which is not going to happen.
And not just the blessing. I mean, I doubt that Israel on its own can keep fighting on multiple fronts at the same time without any support from other forces. You know what I mean?
Yeah, exactly. And so I don't see it accelerating from here. But maybe those will be the famous last words. Let's just hope that is truly the case. Hey, we got just a few minutes. Thank you, Steve, by the way. We have just a few minutes before we have this data that's coming out, and then we're gonna have to bring Joseph Wang in. So let me go around the horn as I'm getting things set up. Grega, what's on your watch list today? What are you looking to trade as I get set up for this data?
Actually, my focus will definitely be on cable. I just think that there is plenty of room for more weakness, but of course, we need some rally first before we can maybe chase and define some levels. But definitely pound, I think it's headed much, much lower.
Okay, and so if we get good data out of the US, you would use that as an opportunity to sell into. I am, just so you know.
Yeah.
But that's what you're saying, right?
Yeah, but it really depends how extended will be till the data comes out here on cable to the downside.
Okay, thank you, Grega. I think focusing on sterling. I mean, this is day one of everybody going, oh shit, what did Bailey say? I mean, you know what I mean? So this is day one of us having to react to it. And a lot of people in North America are looking at sterling going, oh my God, it's already down 1%. How am I going to trade into that? Like I have to sell on rallies and get out of some of my longs. So yeah, I think that's a great way to focus. Ryan, what are you thinking today?
What am I thinking? I'm thinking lots of things today. I'm just going to wait for this data later on. Keep an eye on the prices paid and employment numbers. The employment numbers obviously factor into people's thinking for the NFP on Friday, but after that, manufacturing ISM with that big drop in prices, we'll see if that's becoming widespread as well.
Yeah, and again, this is the services data. This is probably the more important of the two. We got manufacturing data on Tuesday. Today we'll have ISM, but first is obviously the weekly jobless claims that are coming up. So we will be paying attention to that. This is the data flash that comes with ForexAnalytix. I'm going to move that over. And Steve, anything that you're really focused on as we go into today's trade? Oh, we lost him. He left. Okay, never mind.
He's concentrating on lunch.
Yeah, he went on his Greek lunch, which happens to be half of the day. So
Next Tuesday.
All right, guys, we're set up here, and me personally, I'm gonna be looking at this dollar yen. Especially if we start to see some, because I think the best setup would be ISM data comes in a little weak. Weekly unemployment claims tick up, because remember, we've been pushing this 220 and back below 250 for the last few weeks. If that number starts to creep back up again and we get ISM that looks a little wobbly, I think the dollar yen pulls back a little bit. But I am going to welcome a dollar pullback, because you know what would happen is tomorrow's jobs report is probably just not going to be horrible. So any type of pullback in the dollar today is going to give me an opportunity to get long dollars at a little bit better level. And that's what I'm hoping for. I'm hoping that the euro makes it back up towards 110.70, 111. And then I'm going to be shorting it. I'm going to be playing the dollar long and positioning myself for a stronger, or at least a decent jobs report tomorrow. That's how I want to play it going into today. So we'll see, though. I have my dollar positions have been lightened up since overnight, and data is out. 10-year yield or dollar index is coming down. So what the jobless claims come out as? Did you guys see them? Did I miss it?
No, 225. So all
225.
okay.
Okay, there. Yep, just came out. Revisions down by 1,000. That's just nothing. Continuing claims.
Nothing.
Nothing. Yeah.
Nothing.
All right. So yeah, not a big reaction. Actually, no reaction. Basically, we're gonna have to wait for the ISM data. And hey, Ryan, if you don't mind talking for just a second, giving people some final thoughts, you and Grega, I'm gonna go find Mr. Wang in the attendees. So just stand by. Go ahead.
Yeah, I'm not singing. Don't ask me to sing. I've only got a voice for the football terraces. But no, that jobless claims data, all okay. No worries there. Dollar's ticked up a tiny bit on the back of that. Dollar yen went up to 146.70 something. But yeah, yields are poking. Keep an eye on this 3.8% level in tens and 3.7-ish in twos. Because if we do get a break here higher, then that's going to drag the dollar up with it, and dollar yen will probably take off once again. But yeah, actually, dollar's coming off a bit more. 146.56 now trading dollar yen.
All right, yeah, and look at that 2-year that is starting to perk up. So Ryan, thank you very much for filling. First of all, I just want to say when I'm in the ForexAnalytix chat room, all I do is I scroll back as soon as I get up and I start reading what Ryan's been talking about, and everybody in the European markets, what everybody's talking about is happening. It gets me really caught up on what happens throughout the course of the day. So thank you very much, Ryan, for always being ever present in our community. And Grega, I want to thank you from the land of Slovenia, of the most beautiful people on the face of the planet, being here with us today and giving us guidance on your Elliott wave counts in the markets. So thank you so much.
Thanks.
All right, and remember, for more of Grega's analysis, you can get it in ForexAnalytix, all 30 instruments, not just FX, but whether you're talking about boons or the Bitcoin or S&P, you can find them right here on ForexAnalytix. So thank you very much. And let's bring in the one, the only, Joseph Wang. Good morning, Mr. Wang. How are you today? Welcome to the F.A.C.E show.
Hey, good morning. Can you guys hear me?
Yes, we can hear you just fine. It's so good I haven't talked to you in person. I think it's probably been almost a year. And I want to say things have changed a little bit over the last year, wouldn't you say?
Oh, yeah, I would say that. A lot of things happening right now. It's quite an exciting time, actually, in the markets.
It is a very exciting time in the markets. And I Joseph, I just want to say, I'm a big fan. I've been a big fan for several years now, and always love having conversations with you and talking about everything that's happening in the markets. So thanks for joining us today. Dale is he's back in Chicago visiting a friend. He said you were going to be coming, so I was super excited about having this conversation with you today. So once again, appreciate you being here. Let's talk though about, and I want to ask you about interest rate cuts. I want to talk to you about this global phenomenon where you're seeing Bank of England today jumping on the rate cut bandwagon, and it seems like we have this now coordinated effort. Even the RBA might be cutting rates soon too. But I want to get your thoughts on how far we can go. How far do you think the Fed can go amidst everything that's happening geopolitically and port closures, and is inflation really dead? So there's so much to dig into. But let's start with cuts. I mean, how do you feel about where the Fed's at and where other central banks are at right now?
So like you mentioned, we're in a global rate cutting cycle. And I think that's been pretty supportive of the markets. I mean, as the market participants have seen over the past few years, rate cuts are positive for asset prices. Now, one thing that I think is really interesting in looking at all this is that we have this global rate cutting cycle. And so in a sense, interest rate differentials are not really changing all that much, let's say US compared to other countries, with the exception of Japan, which we can talk about. And yet at the same time, over the past few months, we've seen the dollar weaken significantly. So one of the things that I've been thinking of is one of the drivers of currency weakness or strength going forward might be less about interest rate differentials as we all kind of move lower down not towards zero, but just lower in the global rate cutting cycle. But maybe the fiscal situation now compared to other countries, the US's fiscal situation is notably worse. Now, the IMF actually has a fiscal monitor. That's something they publish twice a year, and in it they have a special section talking about their concern of the U.S. fiscal situation, which they forecast to have a fiscal deficit of about 7% a year for the foreseeable future. In contrast, other rich countries have a fiscal deficit of about 2% for the coming years. So at a high level, if you have a large fiscal deficit, you're basically printing more of your currency, and that is not good for the currency. I think that's something we see throughout the world, oftentimes more obviously in emerging markets, but if you behave in that way, I would assume something similar happens to your currency as well. So I think that might be one of the reasons why we've seen this significant depreciation of the dollar over the past few months, even though, Fed just kind of cut rates a bit.
Yeah.
Now, the trajectory of the Fed cuts, I think the market is being a bit aggressive on that. So the market is pricing in, let's say we can be around 3% at the end of next year. That doesn't seem to make sense to me. I think that there's a couple of things that suggest that the U.S. economy is doing better than that merits. So we have all this, again, employment is slowing for sure, but if you look at, let's say, GDP data, it's been revised higher. So it doesn't seem like we justify that level of emergency cuts. But more importantly, if you have a significant fiscal stimulus, fiscal spending, that's supportive of the economy, right? You're basically printing dollars, buying it, using it to buy goods and services. So that I think puts upward pressure on nominal growth and inflation. Again, it's a very muddy picture, though. We do have these port strikes and geopolitical risks that you mentioned, and that keeps me from shorting, say, the 10-year or something like that.
Yeah.
But I think that the market is being a bit aggressive with the amount of rate cuts it's pricing in. But it's something we've seen, I think, pretty commonly the past few months. I remember in January, we were pricing in 7 cuts for this year. So far, we've just had 50. So the market has a habit of pricing in a lot of rate cuts. But so far, I don't think what I see justifies such an aggressive path of policy.
So let me ask you this, Joseph, and you're right. Markets always they overshoot or undershoot as far as expectations go. Right now might be a bit of an overshoot, because they just assume that where's the Fed nominal rate, would you say, at this point?
I mean, we're around 5%.
But what they view as their nominal.
Okay, so I think that my best guess is somewhere around 3.5% would be
Okay.
would be where I think we cross the boundaries between being restrictive and accommodative. I think the Fed themselves right now, the dot plot suggests the median Fed participant thinks it's about 3%. Again, there's some variation there though. So the median participant, actually, if you look at their SEP dot plots, one of the really interesting things is that over the past couple years, they've steadily revised higher their expected neutral rate, and so that's been trending higher steadily, and that reflects their realization that hey, we hiked to 5.5%, and yet we still have very strong GDP growth. Yet markets are at all-time highs. Maybe something's different today than before the pandemic. So if the Fed is at 3%. And it's been going up higher. I think it neutral rate is about 3.5%.
Got it. Okay. All right. So that's where the Fed might see as more of where they should be. But everything that's happening this year, is there scope, or I say everything that's happening. We still have so many things that are happening by the end of the year, especially with this election, and this port closure, which happens at a very unique time for it to happen. Do you think that that's going to have a huge impact on the U.S. economy over this fourth quarter?
So what I understand from that is from what I read in the news articles, it sounds like, and there are people in the industry, I think Craig Fuller is on Twitter is one of the people in the industry who's been talking about this, is that it's probably going to have a pretty big impact because it's not going to be easily resolved. It seems like the two parties are quite far, and at the moment, it's really hard for the White House to intervene to do anything on the one hand, if you support the businesses, force people to call off their strikes, that would be good or bad for good for the economy. But on the other hand, that'd be really bad for the election because you would be, in a sense, standing against the workers. Now, it seems like the impact of this on the economy doesn't really happen until some weeks later, and so that is after the election. So I think this is something we're going to see for the next few weeks. Probably nothing is going to happen with this strike because of the politics. Maybe something will happen after the election, but by that time, the damage has already been done. And so I think it will have an impact on both the jobs numbers, which I think will upset the market, and also the economy, since there'll be shortages in some sectors. But I think the much bigger impact, though, right now is just what's happening in geopolitics. I
Yeah.
think there's a lot of indications right now that so the White House seems to be giving Israel a free rein to do whatever they want. Again, they're scared to do anything to upset Israel heading into an election, right? As we all know, the Congress in the U.S. is beholden to a lot of these Israeli donors or pro-Israel groups, and so they can't do anything until after the election. And I think what's happening is that, from what I hear from many sources, is that Israel views this as a very rare opportunity to achieve their goals. I think Jared Kushner has a long post on X. He's very plugged into that world. They will have a window of opportunity here to achieve all their geopolitical dreams of, fighting Hezbollah and maybe also destroying Iranian nuclear facilities. So they've been, again, doing provocative things, getting also some retaliation, but now they have, I think, the support of the White House and ready and willing to really escalate this and achieve their geopolitical aims. And I think this is not done yet. I think the worst is yet to come. And I think that's a reason for significant caution. That's going to have a bigger impact on the markets than this strike, which is still significant. But like I mentioned before, from what I hear, the damage doesn't really occur until a few weeks later.
Joseph, you do some trading on your own, and that's one of the things I love, the fact that you after you left the Fed, you get you manage your own money, you do a lot of trading in the markets, and so this is going to be a question that is going to have to be an opinion of yours, but it's something that I think we need to be thinking about in light of everything you're saying. We haven't been in a period of risk aversion in quite some time, and here we are with the S&P up at all-time highs and perched right at all-time highs, which typically is not a very bearish event. However, as you're pointing out, there are a lot of risks. In the past, we've seen your traditional risk off type of trades manifest, like gold rallies, which gold is near all-time highs as well. But would the dollar, and I'm asking you, as more of your opinion on the dollar here, and maybe other currencies that could benefit in the event that we see some risk aversion in the markets, where would Joseph Wang be looking to park money from a risk aversion point of view? What are your thoughts?
So yes. Over the past week, we've seen dollar getting a risk off bid, as we've seen consistently for many years. We've also seen gold go up. That's often a response to geopolitical risks. Although, of course, if we do have really big downside, that gets sold off for liquidity as well. I personally, the way that I'm positioned, I'm short futures, I'm long puts, and I'm long gold, and I have a lot of cash, and that's really all my positions right now. So I'm really cautious. I do think that we go, there's a good chance that we can go meaningfully lower, given all the things that are happening. But on the other side, as I understand, after the election, we also have good seasonal effects and so forth that could be supportive. But right now, I think actually I'll give you a bigger macro view. Actually, why I'm super cautious. In addition to these, I think near-term things involving risk in the Middle East and strikes and so forth. In that, I think that what is happening is that we have a good chance that we could have a pretty major sell-off for a few quarters because of what's happening with the rates and currencies. So the Fed is going to cut rates, and if we have downside from war, if we have downside from the port strikes, causing unemployment to shoot up and so forth, we could have a more aggressive rate cutting cycle. Now, this is happening in the context of significant fiscal deficits. So I think that there's some chance that we could have a meaningful depreciation of the dollar in the coming months. Again, 7% fiscal deficit, that's not normal. That is emerging market behavior. So one other thing that happens in emerging markets is that as the currency depreciates, the foreign investors, they get out. So they sell their foreign currency denominated assets and they get out because they don't want to take losses on the currency depreciation. Something similar could happen in the US because foreigners right now actually have very, very high exposure to US assets. I own about 20% of US equities, also a ton of treasuries and corporate bonds as well. US, obviously, world's deepest and most liquid capital markets, also the home of many popular things like AI. So a lot of foreign investors are heavily allocated to US assets. If we do have rapid dollar depreciation, which may or may not happen. These geopolitical risks are supporting the dollar right now, but beyond that, 7% fiscal deficit, aggressive rate cuts, that can't be positive for the currency. And so you could have this loop whereas foreigners lose money on the currency side of their US dollar assets, they sell, causing other people to sell and so forth. So that I think is a risk that's really keeping me from having a big exposure to US assets right now. Also, I want to wait until the election, of course. For all I know, we could have a Republican sweep. Trump really likes to have tax cuts, really likes to, boost the stock market. And of course, foreigners perceive Trump to be good for the economy. Although Trump has been saying he wants to depreciate the dollar, I think the market, just based on what I've seen, seems to link a Trump win with dollar strength simply because he's perceived to be more positive. So that could change everything. So there's a lot of there's a lot of things happening right now. We've got geopolitical risks. We got this big structural dollar weakness due to deficits that I'm talking about, and we also got the November election. Three things here that I don't think I'd feel comfortable having a lot of long exposure until, at the very least, at the very earliest, until after the election.
All right. Well, that's a really, really great answer, Joseph, about risk averse, and it's interesting to hear your views on the dollar too, as we head into the latter half of or the fourth quarter of this year. I wanted, you touched on this, and before we wrap things up, I did want to kind of circle back to other central banks and maybe more specifically what's happening in Japan. Because of this new prime minister, he's obviously caused a very big ruckus in the dollar yen, and in the yen in general. And oh my God, it's like, I actually thought that I wasn't sure if Takashi was the one that actually got elected based on the yen reaction over the course of the last few days. But tell us a little bit about A, the yen, but B, other central banks and kind of how you're seeing it right now.
So the yen, the Bank of Japan is the one huge developed market central bank that is bucking the trend and actually hiking rates. There's actually so one of the Bank of Japan board members gave a speech, I think 2 or 3 weeks ago. In it, he has a really good. Okay, what's awesome about the Bank of Japan is that they actually publish many things in English. So they're thoughtful about people like us who don't speak the language. But they have this really good chart about where they think the neutral rate of interest is in Japan. And so that's very difficult to observe, but they do I think 4 or 5 model estimates of where they are. And their finding is that the neutral rate of interest in Japan, according to all these 4 models, is low. But here's the thing, their current stance of policy, where real rates are right now in Japan, is below all of those estimates. And so they're saying that inflation is above our target and our stance of policy is below all the estimates of neutral rates that we have. And so we got to hike a little bit to make sure, at the very least, we are at neutral because inflation is above our target. So that's the way that they're looking at this. We got to hike rates, we got to normalize policy because we're still being too loose and inflation is above target. So that's their perspective, and that's why they've been trying to hike rates, even as we had a bit of a hiccup in August.
Yeah,
Now,
but Ashiba said that, and he said this publicly, over the last 48
okay,
hours, that he doesn't think the Bank of Japan
let,
should be raising rates.
let me
So
let me get to that, right?
okay,
So
okay.
so that's the Bank of Japan. And
Yeah,
as we know, that's just one side of the story. We have the political angle as well.
sure.
So now we have this new prime minister, and the market's first reaction was that what was pretty hawkish, right? Because the thinking was this guy would allow Bank of Japan to normalize rates. Now, as you rightly note, we have headlines coming in recently that, hey, this guy's saying that the Bank of Japan shouldn't hike his, or maybe he's dovish. So we have that strong reaction in the yen, where GUSD JPY is going up, Nikkei is going up. So it seems like the yen and Japanese assets very sensitive to the path of policy for the Bank of Japan, and maybe the prime minister is, just going to force the Bank of Japan to back off. So if that's the case, then that USD JPY could go much higher, and that would be very risk positive for what's happening in Japan. But I just don't know enough about the relationship between the Bank of Japan and the government there to say that who would win in this kind of dispute. So I give you the perspective of the Bank of Japan, why they think they should hike rates, and we've heard from the new prime minister that he doesn't like that.
Yeah, it's interesting that, and I was talking with Chris Weston from Pepperstone Securities, the head of research over there, last night, and he's like, yeah, I just don't like it when you have these you have politicians that are trying to meddle in what needs to be a more central bank decision. So it's going to be interesting to see how this unfolds, Joseph, especially in the very near future, with a new prime minister and with the Bank of Japan probably going to be at odds based on what you're saying. So as we wrap things up, Joseph, last question for you. Currency wise, where do you think is going to be the best place to be positioned over the course of the next let's call it several weeks, as we try to navigate through this very what's probably going to be setting up to be a very volatile time over the next 4 to 6 weeks? What do you think?
I like gold. And
all right,
the
yellow metal currency.
Yeah,
Yes.
I mean, listen, we got again global rate cutting cycle, as you mentioned, Blake, and also geopolitical tensions. That, from what I read, the worst is not yet here yet. So I think that's very supportive of gold. So that's why I think we have this huge surge upwards. Looks like we're taking a breather for a couple of days, but looking at the trend, it looks like it wants to go higher.
It's hard to say it's bearish when we're sitting at all-time highs. So I can't disagree with you. I have to agree with you there, Joseph. Well, Joseph, like I said, and just for the record, and for those of you that are like, oh, Joseph sounds pretty smart, but you know what? He's very market savvy. If you go to the beginning of 2024, I think for a good month, you were out there running around the Twitter sphere and the YouTube sphere saying, hey, the stock market's going to crash up, and we've had nothing but that, Joseph. If you look at the beginning of this year, in 2024, when you were running around saying that towards the end of 2023, I would argue that at this point in time, the stock market is up at least 20%. So you have been deadly right. It has been nothing but a crash up. So very well done. What's the best way for traders to follow your work?
Yeah, so I'm on Twitter, FedGuy12. You can also check out my website, fedguy.com. I post weekly commentary on that site. And I also, if you guys, this might be a bit too basic for you guys, but I also do weekly market recaps on my YouTube channel, Joseph Wang, where I talk about three things that I found the most interesting in markets every week.
Oh, that's pretty awesome. And I actually try to watch your video right after I finish my week ahead video that I do, because I think it's you cover those 3 topics, and I'm like, man, I should have talked about that. but you're always nailing like what is moving right now. So I posted in our chat box, Joseph's Twitter handle. So if you don't know where to follow him, you have that information now. And Joseph, it's been a real pleasure to have you here, and I'm going to be reaching out to you separately to have you on Traders Summit so we can dig a little deeper into some of these charts that matter. Maybe towards the end of the year. So I want to thank you so much for spending your time with us. I know it's super valuable to you, and for our listeners at home, I know it's very valuable to hear your thought process here. So thank you so much.
No, thanks so much for inviting me. It's a pleasure to be here, guys. Happy trading.
All right. Thanks, Joseph. And if you guys haven't followed him, make sure you do that. And guys, remember tomorrow, live non-farm payroll reaction, instant reaction. We're going to be navigating through the markets then. So I'll see you in about 23 and a half hours, maybe closer to 23 hours from now. Thanks, everybody. Have a great one. And thank you once again, Joseph Wang. You are